Hey everybody, it's Kevin once again coming to you with Weeds Weekly Wrap. And this week what we're going to be talking about is a sinking ship. We have some sticky icky. There's a new floor in town. It's going to be time this week to connect the dots, which is really exciting, and place your bets, place your bets. Builders are happy once again. And then we're going to talk about buydowns, and we're going to finish off with the lag effect. So let's just dive in. And here at Weeds Weekly Wrap, what we do is we talk about this past week, this upcoming week. We give some random thoughts. We're going to talk about buydowns, and then we're going to talk about the lag effect, something very personal to all of us in the real estate space. So let's just first hit it off. This past week, we were once on a slow boat to China. We are now on a sinking ship. And it's not an imploding sinking ship. It's a slow, steady sinking ship. But make no mistake about it. The data that we were hoping for over the course of those 7 days, which turned into about 10 trading days, was not in our favor. It started with the jobs report that was not in our favor, the big one, the month over month, which last week then was followed by CPI, which nearly missed its number. Let's just be very precise, but that also happened the previous month, but only to be topped by PPI, which was double forecast, which is very inflationary. And then it finished out the week with the New York manufacturing number, which was 3 times what forecasts have expected. So all in all, it was just a clear indication that we still have a ways to go. The data is clearly not there for the Fed to make any significant move in the near future for the Fed funds rate. So the big question remains is, when are interest rates going to come down? And the effect was, hey, inflation is super sticky. It doesn't seem to really be going anywhere fast. We thought at the beginning of 2024, all over the media, a majority of economists, we had several real estate professionals telling us we were going to get 6 cuts when the Fed was meeting 8 times this year. I mean, there was a lot of rhetoric around the Fed being aggressive with rate cuts, which just has not materialized because the data just is not supporting that. With the sticky icky of inflation, we are here today. And what it really did is it sent us back up into the 7% range. So once again, as I have said previously, talking interest rates with your clients is just not what you want to be doing these days. We want to be talking about other rhetoric, which we're going to dive into here in a little bit. The good news is the following, and it's good and bad, but this week we have the Fed. And a lot of people had anticipated when 2024 started, they highlighted the March meeting as the first time the Fed was going to decrease the Fed funds rate. If you have been listening to yours truly and following this, we have thought for a long time that's going to be July. I still think it's going to be July, even though there is some rhetoric now for a June. And I also have the feeling it could even push back into September. So we want to just really keep a close eye on that. But the good news, and again, it could be good news, is the dot plot comes out this week. I'm not overly concerned with the language of what the Fed is going to say, although I think a lot of people are. Traders, economists are really going to be following that, just simply because we now have 2 consecutive months of higher inflationary data that we were not anticipating for 2024. But I think the message from the Fed is going to be the same. It is going to be a data-driven decision. So therefore, if that is the case, hey, they're going to be waiting for data consecutive months, and I think they're going to err on the side of caution even after they get those 2 months. And that's why I think it pushes into July, if not even September, for the first Fed funds rate cut, because simply they want to err on the side of caution. They're going to be really skeptical if inflation is really under control and should they start reducing that Fed funds rate. But the dot plot comes out this week. It's one of the 4 times that the Fed will come out. They come out every quarter. And what they do is basically every individual official of the Fed will outline where they anticipate rates are going to be as we move throughout this year and into the quarter of 2025. And it's really good because what it allows basically, I think, traders and economists to do is kind of find that middle ground, kind of find possibly what official has been right, what official has been way out of bounds, kind of get the outliers out and have a methodology of when we can really think, what is the Fed thinking in their head? Because now they have to put it on paper, not just verbiage. They have to dot plot out where they think interest rates are going to be, or where the Fed funds rate is going to be, which i.e. will correlate to the 10-year treasury. So we go into place your bets, right? Are we talking summer? Are we talking spring? So late spring would have us right before if we think we're going to get that June cut, but I think we're going to be in July. So if I had to be a betting man, we are not going to see the Fed begin to decrease the Fed funds rate, or interest rates for that matter, if people want to look at it that way, until July or September meeting. To me, that's just the facts. I know there's a 56% chance that they might do something in June. I think, again, they're going to err on that side of caution. I can't stress it enough. The one good piece that came out for us is that builders are still happy. Builder sentiment is still very excited. And I think it has a little bit to do with where we're currently at with interest rates. Look, if you're a builder right now, these higher interest rates have proven to be favorable to you. You had the ability to refinance your land before development when interest rates were extremely low. You now have a lot of movement, a lot of equity built up in that, and you're able to offer deep discounts. You're able to offer potential buyers, and they're buying a brand new house. So affordability, going back to our term for 2024, the affordability of a new home where everything is brand new HVAC, new roof, you get a warranty, blah, 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 blah. It's so much more appealing than a current existing home. So once again, I think that's why we're still seeing home builder sentiment on the rise. Now, what's going to be interesting is as we move through 2024, we get past the election into 2025, I think you're going to see a reverse. I think builder sentiment is going to start to tamper down. And it's simply because then interest rates are going to become more competitive, which is going to decrease their advantage in the marketplace. Right now, they have a distinct advantage. All right, so let's talk buydowns. And I can't stress it enough. I talked about it on Friday, and I know that, through a lot of 2023, we talked about it, but we talked a lot about it from a builder perspective, right? We talked about 3-2-1 buydowns, 2-1 buydowns, and that allowed builders to really get aggressive and buy down buyers' interest rates. Now, as the market is kind of settled, and for like the last 6 months, the media, the perception for everybody around regarding real estate and interest rates is, hey, we're hovering in the high 6s to low 7s. We're around 7%. So again, that perception that's out there, the 1-1 buy down is exactly what you should be talking about with your clients, whether you are on the buying or selling side. Make no mistake about it. I think every deal, every offer that you're making on a potential house should require a buy down, a 1-1 buy down. You put it in as seller concessions, and for every potential listing you're going to, or for every listing that you have coming, you should have in there a 1-1 buy down. It's inexpensive. The chart clearly shows for a $2 million purchase price with a down payment of $400,000, it's $12,624 to you as a seller to buy down that person's rate. And again, perception's reality. It gets them down to the rate of 6%. They're now in the 6s. They have that rate for an entire year. And then come Q2 now of 2025, they're going to get an opportunity to refinance. And all signals at that point indicate we are going to be through whatever we're going through right now. Rates will be decreasing. The Fed funds rate will be coming down. Clients will at least have an opportunity to refinance at that rate, if not lower. So that's a positive. So again, buydowns. Being educated and talking to your buyers and sellers about that, making it a common practice in the existing real estate market for buyers and sellers, I think is an absolute must to keep people interested, to keep people moving, and it gets them thinking that it's outside the box. It's beneficial to all parties. And lastly, I wanted to discuss the lag effect. So what is the lag effect? The lag effect is essentially, given all these rate cuts by the Federal Reserve, right? They did 11 in a row, starting in 2020 22 all the way through 2023, the last one being July of last year. We have not seen any changes in the Fed funds rate since then. The lag effect is essentially when is that going to spill over into the economy? And I think we're starting to see signs. But one thing that I looked up that I thought was really interesting is that over the history since 1981, the average time it takes for the lag effect since the last cut to have an effect on the economy, it's 11 months. 11 months. So we're coming into that right now. These summer months are going to be when the lag effect is directly going to hit us. And I think that's going to push us into some type of recession. I think whether we are in it now, because obviously the first cut was in 2022, so we're starting to see the beginnings of that. But this trail effect, we haven't seen the 11 months since, your April. So we're coming right into the meat of when the Fed was kind of coming to the end, but 4 more rate cuts. And we just haven't seen them filter into the data that we have now. We're starting to see inflation come down a little bit, but it's sticky. It won't go anywhere. And that is clearly due to the lag effect. So shame on me, although I did the research today, but should have looked at that a lot sooner. I think that would have gave us a clear indication that all the media, unfortunately, I think a lot of all these government agencies, including the Fed at times, gets political. The media clearly is. And I think it's unfortunate that, shame on me and for not looking into that, and for people getting a little out of the box thinking the beginning of 2024 and towards the end of 2023, that they were thinking that a rate cut was going to happen. I was looking more at the economic numbers as opposed to the history, but the history clearly shows that the lag effect, we're not looking into the summer, and we should have just known better, because our job as professionals is to talk to our clients and not get too optimistic or too pessimistic about the market, but to give them accurate data. Give them a reason to be a buyer. Give them why they want to buy today. Help them understand what's going on in the marketplace now, a little bit of history, and what they can see in the future. So, the big message I think that we should be going to our clients with, and us as mortgage professionals as well as real estate agents, is number one, we need to talk about the Fed's lag effect and its timeline. Let's talk about, hey, based on that, we're going to start to see rate cuts come this summer into Q3 through the election. And then that's why 2025 is going to be a much better year for us. We also want to be talking to them, as already discussed, about the power of the 1-1 buy down, how that is beneficial to both the buyer and the seller. I think it's critical for a buyer to feel comfortable getting into the sixes, low sixes, 6%, high fives is really sexy. I think that's possible. And I think that's something that both buyers and sellers can really get on board with. And I think it's going to get people off the fence. And then lastly, we want to be talking about future appreciation. Every state, every town, every zip code is different. So you want to be really clear on that. But the overall picture for appreciation has been up. Now, depending on where you are, you may see something different. But again, we want to be talking about a future appreciation. We want to be looking at pre-pandemic. What was the average appreciation that we could see at that time? And that's what we want to be talking to our clients about now. We're coming to the end of this lag effect. And what's going to happen is it's going to propel people getting off the fence, especially if we can use these buy downs. Once we get into the summer months, once we get through the election, we are going to see increased activity. You heard it here first. I think a lot of people are saying it, but hey, I was right about this late summer first Fed rate cut. I'm telling you, come Q1 next year, we are going to be in a much different environment than we are today. It'll be a lot busier, and that's going to mean, hey, more inventory, but a lot more buyers getting off the fence due to the lower interest rates, and you're going to see home prices go up. So the great time to be getting off that fence and talking about a future appreciation is now. All right, everybody, have a great week. I know that was a lot to digest. Let's continue to stay optimistic, but once again, we want to be clear. We want to be factual with our clients. We want to talk to them why now is a good time, backed with factual and a strategy, the 1-1 buy down, to get them off the fence, to get them in the house so that come 2025, 2026, they're picking up the phone and saying, hey, Kevin, thank you so much. That was great advice. We have a referral for you. All right, everybody. Cheers. Have a great week. You need anything, please don't hesitate to give me a call or a text. I'm working all week as usual and looking forward to hearing from you soon. Happy selling. Cheers.